Hey traders, have you ever heard the saying, gaps always fill? It's one of those stock market myths that sounds convincing, but is it true? Today, we're diving into a back-tested analysis from quantified strategies to uncover the truth about gap filling in stocks. Stick around to learn what the data says and how you can trade gaps. First, let's break it down. A gap happens when a stock's price jumps from one day's close to the next day's open, leaving an empty space on the chart. Gaps can be common gaps, just regular price moves, runaway gaps, fueling strong trends, or exhaustion gaps, hinting a trend might be fizzling out. But the big question is, do these gaps always get filled? Let's see what the data says. To find out, we're leaning on an article from our website, focusing on the S&P 500 ETF, SPY. We dug into 8 years of SPY data to see how often gaps fill, and here's where it gets juicy. So, do gaps always fill? Not quite. Here's what the backtest revealed. 1. Small gaps, think plus or minus 0.25%, often fill the same day. These are your bread and butter gaps. 2. Larger gaps, like over 1%, are a different story. Only 28% of bullish gaps and 33% of bearish gaps, bigger than 1%, fill. Some never do, especially in single stocks. Third, bearish gaps fill more often than bullish ones, thanks to the market's upward bias. 4. Fading gaps, trading against the gap's direction, can work, especially on Fridays or when the gap is outside yesterday's range. 5. Gaps fill better when the previous day's trading range is tight. So, what's the takeaway? Gaps don't always fill, but smaller ones are more likely to, and fast. There you have it, traders. Stocks don't always fill gaps, but the data gives us a roadmap to trade them smarter. Please check out the full article in the description for more details. Hit that like button if you learned something, and subscribe for more data-driven trading tips every week.